The following production is presented by League Info Site and the Credit Union Broadcast Experience, QTV.
Hello, I'm Sean Wolbert.
And I'm Gloria Ledoux.
Bringing you the quarterly compliance update at the CU Compliance Connection by InfoSite, only on CubeTV.
This presentation provides information on the compliance issues your credit union has worked on in the first quarter of 2014 and the issues it will face in the second quarter.
During the first quarter update, we're going to look at things that we've talked about many times in the recent past. So this isn't new information for you, but we're going to cover it anyway to make sure that you're in compliance with the new rules and requirements. The first is the NCUA's liquidity and contingency funding. And then we go into the CFPB rules, which we have gone over and over, but we've got the ability to repay for qualified mortgages, loan originator compensation, valuations and appraisal requirements, the HOEPA rules, and mortgage servicing.
We will also go over the NCUA Credit Union Service Organization, or CUSO rule, which goes into effect in June.
NCUA liquidity and contingency funding plans is something that the federal government and the NCUA have put into place to really protect credit unions in a time of interest rate risk. And we're entering that period where interest rates are going to start to rise, and credit unions, it's going to be a little tougher for credit unions, especially with the very low term rates they're doing on loans for the longer terms that they're giving out. I know somebody who got an auto loan just the other day, 0% interest for 78 months.
Where was that?
I can't tell you on this. I can't tell you on Cube TV. However, the rules basically state that federal credit unions with assets less than $50 million must maintain a basic written liquidity policy for managing liquidity and a list of contingent liquidity sources. Federal credit unions with assets over $50 million must have a contingency funding plan that sets out actual strategies for liquidity shortfalls in emergency situations. And for federally insured credit unions with assets over $250 million, they must have access to a backup federal liquidity source for emergency situations. Additionally, they must become a regular member of the Central Liquidity Facility, or the CLF, or establish a borrowing relationship with the discount window, which is through the Federal Reserve.
Right. So now let's jump to the CFPB's ability to repay rule. Again, as Sean mentioned, we've been talking about the CFPB rules for a while, so hopefully this is just a review for everybody. The ability to repay, or ATR rule, covers your closed-end loans secured by a dwelling that's first or second lien, and it's not limited to primary residence. And it requires that the credit unions are making a reasonable, good faith determination that the member has the ability to repay the loan. Nothing earth-shattering, since credit unions certainly don't want to underwrite a loan that the member does not have the ability to repay. Okay? But in order to comply with the rule, there are 8 underwriting factors the credit union must evaluate and document. So please check your policies and procedures to ensure that you reflect that you're considering those 8 underwriting factors. Now, after the credit unions have complied with those 8 underwriting factors under the rule, the credit union can determine if the mortgage they are underwriting will be considered a qualified mortgage or not, which provides the credit union with a presumption of compliance with the ATR requirements, or a safe harbor. Now, there's 4 types of qualified mortgages with different terms and conditions to comply with to meet the standards, but we're just going to talk about them generally. The general QM category has the debt-to-income requirement of no more than 43%. So loans that have a debt-to-income ratio above this percentage will not be considered qualified under this particular QM category. For a loan to be a QM under the temporary QM category, it must be eligible for purchase or guarantee by a GSE, that's Fannie or Freddie, which can be established by a valid recommendation from a GSE automated underwriting system. Now, if you are a small creditor, which means you have assets below $2 billion at the end of the last calendar year, and together with your affiliates, you originated no more than 500 first lien, closed-end, covered transactions in the preceding calendar year, then you are eligible for 2 additional QM categories. So you have the 2 that we just went over and these 2 additional ones. The first is the small creditor QM, and that requires you to not exceed certain points and fee thresholds and to consider debt to income or residual income, but there's no specific threshold, so there's no 43% requirement. Lastly, there's a balloon payment QM for small creditors, which will be available until 2016. So after that, as far as we know, it will be for credit unions serving in rural or underserved areas only. But again, we have that exemption for balloon payments for small creditors until 2016, no matter if you're in rural or underserved areas. Again, there are certain requirements credit unions need to comply with to obtain this QM status, but again, there's no specific debt to income ratio or threshold for the balloon payment QM.
So now we'll go into the CFPB loan originator compensation rules. Glory, I think it is a rare occurrence that credit unions actually compensate loan originators based on some kind of an arrangement where they're doing commission structures. I don't think that's normal for our industry. However, we do know that there's credit unions out there that do this.
Yes.
And so the rules don't ban it, but they highly restrict this practice. Mortgage loan originators cannot receive compensation on any of the mortgage loans, terms, or conditions. There's no dual compensation. If a mortgage loan originator receives compensation from the borrower in connection with the mortgage loan, they cannot receive compensation from their organization, which would be the credit union, or another person for the same transaction. Additionally, the rule makes slight changes to the SAFE Act requirements for the MLOs who must be registered according to the SAFE Act. The MLOs and the credit union, and I want to say that again, the MLO and the credit union must include their name and NMLS ID, that's the National Mortgage Licensing System, on the following loan documents: the credit application, the note or loan contract, the security instrument, and generally you should include it on any of the documents that require the member's signature.
So now let's talk about the CFPB valuations and appraisal requirements. The valuation and appraisal rules amended both TILA and ECOA, so the Truth in Lending Act and Equal Credit Opportunity Act. The amendments specific to TILA apply to your high-price mortgage loans. So your first lien, closed-end loans with an APR above the APOR by more than 1.5%, 2.5% for jumbo loans in first position, or 3.5% for subordinated liens.
You know,
I see you wanted to say something.
I did. If that was too much of a mouthful, and that's a lot of information all in one condensed version, the CFPB has those guides.
The small entity guides.
The small
absolutely.
entity guides are great. Go out to the CFPB website because it's cfpb.gov.
Yep.
And you can find all of this information that both of us are talking about
Right.
in those guides so that you can look into what you need to be doing.
Yeah, and we've done presentations on the CFPB rules, and just talking about them generally has taken us probably about 3 hours to cover the topics. So to condense this down to 10 minutes, we are just giving you guys a really brief overview. So as Sean mentioned, make sure that you're checking out the Small Entity Compliance Guide and the regulations to get more detail. So back to the high-price mortgage loans. For those high-price mortgage loans that the credit union is required to provide a disclosure to the member within 3 days of receiving an application, basically that they're entitled to receive a free copy of their appraisal. This requirement is also part of the ECOA rules. So for your high-price mortgage loans, you'll be required to obtain a written appraisal from a certified or licensed appraiser and provide that copy of the appraisal to the applicant no later than 3 business days before consummation. Now there are a few exemptions to this rule, so again, reference the small entity guide or the regulation for further details on it. Now the ECOA rule applies to open and closed-end loans secured by a dwelling, but only loans in first position. So consistent with the TILA rule, credit unions are required to disclose the right of the member to receive a copy of the appraisal and or valuation within 3 business days of receiving the member's application. Additionally, credit unions will be required to share copies of appraisals or other written valuations promptly with the applicant. So different, if it's a high-priced mortgage loan, you have to get a certified appraisal. But under the CUSO rules, if it's not a high-priced mortgage loan, you can use valuations, but whatever you're using, you have to provide a copy to the member.
Yep. One of the other things with this rule, and one of the places that's going to be, the sticking point for credit unions, a lot of credit unions don't realize that this rule applies to liens in first position.
Yeah.
So if you have a second mortgage product, which is a higher rate,
Yep.
but it's in first lien position, you have to really consider that, and you have to look at it differently than you normally would.
And that's for a number of these CFPB rules.
It is. Now if we look at the HOEPA rule, which is the High Cost Mortgage and Credit Counseling Rule, that made significant changes to the treatment of high cost mortgages. It's important to remember that HOEPA rules apply to consumer credit transactions secured by a principal dwelling, including purchase money mortgages, refinances, closed-end home equity loans, and yes, I am going to say it, now it does include open-end credit plans and HELOCs. High-cost mortgages require special disclosures that must be provided to the member 3 days before consummation or account opening. Additionally, the rule bans certain loan features for high-cost mortgages, and those features include prepayment penalties, due-on-demand features, and balloon payments. Yep, balloon payments. But there are 3 exceptions to the balloon payment requirement. If the payment is scheduled to adjust to accommodate the member's seasonal or irregular income, that's okay. For short-term bridge loans to finance a new home purchase, when the member is selling an existing home, those features are okay. And if the credit union is serving predominantly in a rural or underserved area, and we've seen this over and over throughout the CFPB rules, we have this rural and underserved area, then they're able to qualify under the rule. The CFPB publishes a list of the rural and underserved areas, so you need to check that to determine if you qualify for this exception for the balloon payments. The rule also contains a requirement that members receiving high-cost mortgages must have HUD counseling before closing on the mortgage loan. As a part of the counseling requirement, credit unions must provide a list of home ownership counseling organizations to all members applying for mortgage loans within 3 business days after application. This includes first and subordinate liens on residential real property designed for 1 to 4 families.
Now we're going to talk about the CFPB mortgage servicing rules, and there are a significant amount of requirements for credit unions to comply with related to mortgage servicing. So just to give you a general overview, the new rules amended both RESPA and TILA. The RESPA revisions require credit unions to comply with regulation changes related to error resolution and information requests, forced placed insurance, general servicing policies and procedures and requirements, and early intervention with delinquent members, continuity of contact with delinquent members, and loss mitigation. So there's a lot of them, and they all have numerous requirements. These rules apply to closed-end consumer loans secured by a dwelling. The mortgage servicing rules also amended TILA and made changes to the interest rate adjustment notices for adjustable rate mortgages, established requirements for the prompt crediting of payments and responses to requests for payoff amounts, and established periodic statement requirements for closed-end mortgage loans, which we've been hearing a lot about. So credit unions that are considered a small servicer, which the CFPB defines as the credit union together with their affiliates servicing 5,000 or fewer mortgage loans, and the credit union or its affiliate is the creditor or assignee for them all. So if you're considered a small servicer, you are exempt from certain mortgage servicing requirements. However, as a small servicer, I think it's easier to list what you are still required to comply with, and that is the armed disclosure provisions, prompt crediting and payoff statement provisions, and other forced placed insurance provisions, error resolution and information requests, provisions and some of the loss mitigation provisions. So there's certain things that you're exempt from but also have to comply with under different mortgage servicing rules. Again, because there's so many components to the servicing rules, we really encourage credit unions to review the small entity guide or the relevant regulation for further details on the requirements under each rule.
Yeah. And now that we've covered the compliance issues that credit unions have worked to implement over the first quarter of the year, we need to address upcoming compliance challenges.
So we're going to talk about the NCUA's CUSO rule, which is effective June 30th, 2014. So CUSOs will be required to provide basic profile information to the NCUA and relevant state authority. So certain CUSOs that are considered complex, which are those performing what the NCUA deems to be high-risk activities, such as credit lending and information technology, just to name a few, will be required to report more detailed information to the NCUA, including audited financial statements and customer information. So these CUSO requirements will apply to state-chartered credit unions with subsidiary CUSOs. So credit unions should really, if they have a CUSO, review NCUA Letter 13CU13 to determine if written agreements between the credit union and the CUSO need to be amended to comply with the new requirements under the rule.
Well, Gloria, we've come to the end. The second quarter of 2014 is looking kind of quiet on the regulatory front.
That's just of what was published. I think we're going to be hitting a lot more regulations that will become effective out of the NCUA and the CFPB.
Yep, because we're looking at some disclosure changes near the end of the year.
Yep.
So stay tuned, and thank you for joining Gloria and I at the CU Compliance Connection. Stay tuned for future broadcasts on issues that affect your credit union. We're here to help you at the CU Compliance Connection by InfoSite, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.